I had a client say the other day, "Where's this recession that you've been talking about? It's not evident in the stock market." Well, I got news for you. If you look at the most economically sensitive areas of the S&P 500, they're telling you the same story I'm telling you. The AI trade has nothing to do with the business cycle. That is long-term secular growth, and utilities and staples. Really, you're going to say to me this is a bullish stock market when they're at record they're at record highs and leading the way, the two areas that you want to own in a recession, despite the fact that the stock market is still flat for the year and has done nothing since the November election. It's just been, I said at the beginning, a meat grinder and a roller coaster ride. That's all we've gotten. All we've gotten in the past 6 months in the S&P 500 that everybody, and I guess based on your question, that I would include you, Anthony, believes that the stock market is doing just fine. It's done nothing for 6 months. If you're bullish on the stock market, you don't want it to be flat. You don't want to be taking equity risk and capital risk and then have a flat market. That's not why you buy equities. You buy equities because you think they're going to be going up, but they have not been going up for 6 months now. To me, that's the more important story. The fact that we bounced off an oversold low in April, to me, is just background noise. The bigger picture is that the market is flatlining, and that the most cyclically sensitive parts of the market are actually in decline. To me, that's the real story beneath the story.
Hey everyone, welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcome back a very popular guest, David Rosenberg. So David is the founder and president of Rosenberg Research and Associates. So David, thanks so much for coming back on the podcast.
Well, thank you, Anthony, for inviting me back on.
No problem. Really looking forward to the conversation. I was saying before that, unfortunately, Trump's taking over, I guess, a lot of what we talk about. But maybe, let's start very broad. I'm sure he'll get mentioned. What are you currently seeing in the markets and the economy overall?
What I'm seeing is otherwise known as MUGA, MUGA, make uncertainty great again. So at a personal level, I get up at 4 a.m. I write my daily missive. I publish it, and then by 9 o'clock, I have to rewrite it. Then by noon, I have to rewrite it again. By the 4 p.m. close, I'm rewriting it again. So this is my life. I just really feel so much empathy for anybody who has to manage money for a living, because this is just one complete meat grinder.
Yeah, definitely is. So I guess taking a step back, obviously it seems like tariffs were coming on a couple of months ago, Liberation Day. It was only 2 months ago. It feels like a lot longer. Everything was coming, all these negotiations with China, and now that it was reversed with the courts, and now maybe Trump saying China's, not following through with their negotiations, and then probably by the time this goes up, things will be different. Yeah, how do you look at this?
Well, look, now that the judiciary is involved, and we now have courts and appeals, it seems to me as though we're entering into a new chapter of this elevated and elongated period of heightened economic and policy uncertainty. But there's something that we really have to get to the core at, which is that tariffs and totally rebalancing and reshaping global trade for President Trump is like a religion. I mean, we can all talk about the art of the deal, and that maybe all of these aggressive tariff threats are just a ruse to get deals. We hear about deals, we haven't seen any yet. And time is more or less running out before this starts to truly impair President Trump's credibility. But just remember that Donald Trump went on this tariff and trade crusade vocally and emphatically back in 1987. And he didn't let up when he was a private citizen, and he hasn't let up in both of his terms as president. He has stated on record many times that tariff is his favorite word in the dictionary. And what I go back to, because you mentioned Liberation Day, back on April the 2nd, to which I have been saying, liberate us from what? Our sanity. And you go back and you think about why were there reciprocal tariffs with crazy numbers and different numbers on all these various countries, is because of what this additional levy on top of the 10% baseline tariff, what they implied. Each one of those numbers was really a quotient. It was a given country's trade surplus with the United States divided by their export base. And that was the reciprocal tariff. And the hidden message behind that was that is the number, country by country, that would totally eradicate, totally eliminate that bilateral surplus that country A, B, C, and D were running against the United States. So you have to dig through, notwithstanding the roller coaster ride we've been on, and the threats, and then the reprieves, and then the alleged deals, that this is really the mindset of the president and his super protectionist team, which is that it wants, in the end, as its ultimate goal, the complete evaporation of trade surpluses from the rest of the world on the United States. That's the one thing we have to take out of this, is that is the ultimate goal.
I'm guessing you don't think that's possible. It seems quite outlandish.
I don't think it's possible, and I think it's irrational and totally impractical. And everything that we've been seeing, and I know that we're all focused on this minute by minute, hour by hour, day by day. It's been an incredible headline-driven market, but we have to understand, what the end game is and what the implications are, because what this is telling me is that the administration doesn't seem to fully comprehend how the balance of payments works, and that really troubles me, because the balance of payments by definition have to balance. So the United States does run a trade deficit with the rest of the world, but it runs an equivalent capital account surplus with the rest of the world. So what happens is that these accumulated trade deficits, primarily on the product side, are met with, they coincide with an equivalent inflow of capital into the United States, because the balance of payments have to balance. Now, it's an academic debate as to what drives what. Does the current account drive the capital account? Does the capital account drive the current account? But the balance of payments have to balance. And it's totally normal and apropos that the world's reserve currency traditionally does run trade deficits with the rest of the world. It makes perfect sense that the richest and the wealthiest and the most powerful country in the world runs trade deficits with the rest of the world. That is just common sense. But the view in Washington is that this is just stealing jobs and investment from the United States to its trading partners. But it just comes down to Sir Isaac Newton's, famous third law of motion about every action has an equal and opposite reaction. The United States benefits from these trade deficits by the capital account surplus, because what these accumulated capital account surpluses, what it's meant is that not only do foreign investors help fund the US fiscal deficit because they own about $9 trillion of treasury securities, but they also help fund the debt market for the corporate sector, because it's not usually discussed, but should be, that the foreigner also owns about $5 trillion worth of US corporate bonds. And then the big mama is the equity market. And everybody always talks about the buyer strike, the foreign buyer strike on US treasuries. But the foreign investor owns twice as many US equities as they own treasury securities. They own almost $20 trillion of US equities, which of course helps fund corporate America. So that's the net benefit. You see, you can always just focus on one side of the balance sheet and say we're a loser because we're running trade deficits, and that means these jobs in manufacturing are being created somewhere else. But the offsetting benefit is that the United States, by virtue of these capital inflows, consistently have a lower cost of capital that would otherwise be the case, both the debt and equity cost of capital, and a higher rate of return on assets. And that, therefore, creates the tremendous increase in wealth that the United States enjoys that's not comparable in any other country. Of course, it's a vicious circle because that wealth creation generates an impact on confidence in spending. And there is a 95% correlation between consumer spending and imports. And so that's why the United States has just about the lowest personal savings rate in the world. And at around 70%, it has just about the highest consumption to GDP ratio in the world. So, how do you not run trade deficits with the rest of the world when their savings rates are higher, their consumption ratios are lower, the rest of the world lives more frugally, but the rest of the world also has much lower wealth accumulation? So there's a symbiotic relationship between the current account and the capital account. And my concern all along has been that the White House just focuses on the trade deficit without realizing that the trade deficits have coincided with years of accumulated capital inflow that has made America wealthier. I think the problem in the United States is how that wealth and that income has been distributed. It is not, it is not the fault of the foreign investor. It is not the fault of the foreign producer that to this day, whether you have Democrats in power or Republicans in power, these gaping wealth and income inequalities. All we've had is a situation where fiscal and regulatory policy has benefited the upper end of society in the United States. And that's why the lower end has continued to lag to this very day, which creates its own societal problems. So you can point the finger at America's economic problems and blame it on the rest of the world. But the problem to this day, and included in this big, beautiful bill, does not address, I think, what remains one of the fundamental constraints on the US economy and on its society, which are these virtually unprecedented income and wealth inequalities. That's really the issue here. And the problem with tariffs is that a tariff is basically not much different than a sales tax. Now, you can argue about how much gets passed through. How much does the domestic importer pay the duty? Then how much does the wholesaler pay the duty? Then how much does the retailer pay the duty? And then what ultimately gets passed on to the consumer? But it is foolhardy to believe that none of it gets passed on to the consumer in terms of higher prices. That is just ridiculous. But again, it bothers me when I see out of the White House that there's not going to be any inflationary impact whatsoever. There is. And the problem is that wages are not going to keep up because the labor market is loosening. So this is going to crush real work-based income for the most vulnerable parts of society in the labor market, who will not have the bargaining power this time around to make up for what is going to be a price shock, whether it's big or small. There is going to be a price impact that's going to impair real wages. And once again, who's going to get left behind is going to be the little guy. And so this is going to foster more, I think, resentment and dislocation, especially from a societal backdrop, from what's happening now on the trade side. Everybody says that, well, middle America got burnt by all these free trade deals and it got burnt by globalization. No, no, no. I am not willing to throw the works of Adam Smith and David Ricardo and the theory of comparative advantage into the waste paper bucket. I'm not going to be doing that, and nobody should. The problem in America is how government policymakers have chosen to ignore how to distribute the fruits of globalization. It's just been allowed to further widen these income and wealth disparities. And that is, in my opinion, top three issue in the United States today. And unfortunately, it's not getting much attention.
Yeah, it's probably something that's basically most Western countries around, probably most countries around the world. Do you see this being a margin issue then? Is it just that corporate margins are far too high and they need to come down?
Well, I'm not saying anything needs to happen. What I'm saying is that we are on an unsustainable path. If you take a look and we get the quarterly numbers from the Bureau of Labor Statistics, you're going to see that starting about 40 years ago, the labor share of income was at a very high level. And that was back in the, Leave It to Beaver days where there was stability in society. For the past 4 to 5 decades, that number's only been coming down and is at a record low. I'm talking about the labor share of income. It's at a record low. Nobody talks about this. But yet productivity is at an all-time high. So you have a situation where normally the proletariat should be bearing the fruits of productivity, but they're not. Their share of income is going down. If you're taking a look, for example, at real weekly earnings out of the monthly non-farm payroll report, it hasn't budged in the past 5 years. But as you said, profits have done great. Profits have done great. And look, I'm a capitalist. But capitalism and democracy are always dancing a tenuous dance. And you do want to preserve democracy. Capitalism needs democracy. And so, yeah, I'm a little bit worried about what I'm seeing because there is no effort, either in fiscal policy and there is no effort on this trade policy. There's really no effort here, nor has there been for many, many decades to ensure that the income pie is being distributed in a more efficient manner. That's what I'm getting at. That's the missing link in these tariffs. It's going to raise prices not on recreation services, which a lot of low-end consumers can't even afford anyways, but it's going to raise the price of a wide array of consumer staples, which people need, and the low end of the income strata spend almost 100% of their earnings on. They are going to get squeezed big time. So I just feel that this tariff and trade war is a colossal mistake. It has a tremendous amount of political capital behind it, but it is a huge policy misstep and will have laws of unintended consequences that people aren't talking about today. I shouldn't say that because I'm talking about it in my daily, but this will not end well.
Yeah, it seems like you mentioned the sort of big, beautiful bill that they're sort of trying to pass. Obviously Doge has gone the way of the dodo. The people it's just sort of being pushed to the side. So there's deficits are going to continue to expand. Do you see this continuing to have an issue on the, I guess, the long end of bonds, or how do you see that impacting that? Because that's another huge issue that we're seeing.
Well, there's I guess the answer, and I'll be a class economist here, is yes and no. I mean, you could run up these deficits and debts, but so long as they can be financed, and maybe even financed at lower yields, that can be accomplished so long as investors have confidence in policy. So I think that you have a situation now where you're getting these large scale deficits higher than were previously projected. Although let's just be clear about this. All of the stimulus that people are talking about is not real stimulus. I mean, they're raising the debt by $3 trillion in the next decade, but 4 trillion of that just comes from not having the 2017 tax cuts expire. So when you benchmark it against the status quo, which is the here and now, there's actually restraint. There's not stimulus, but still, the deficit projections are much higher because the CBO was scoring all of this benchmarked against the prospect that the administration was serious in 2017, that these tax cuts on the personal side were going to expire at the end of this year, but obviously kick the can down the road. The problem is not so much the deficits, it's financing deficits at a time when there is a lack of confidence in the investor base on US economic policy. That's the primary issue. When you start, even if the administration is right that the rest of the world have just been rip-off artists for decades and decades, it has to be remembered that they have been funding these deficits to a large extent and funding other aspects of how corporate America is financed through the debt and equity markets. That tends to be forgotten. So I would say, yes, this is a very complex situation, but financing large-scale deficits at a time when you rely on foreign investors and they are losing confidence, which you're seeing, by the way, in the behavior of the US dollar, that is a risk for the treasury market, no doubt about it.
Yeah, and as you say, sort of seeing basically everything in the US going down. Well, we haven't seen stocks yet, but the dollar's definitely going down. It looks like,
Well, you can
foreigners are
say you haven't seen
withdrawing.
stocks yet. Well, well, hold on. They haven't seen stocks yet. You can't just look at the S&P 500. It's being held up because of the AI trade, utilities, and consumer staples. If you're taking a look at what's been happening to the home building stocks, the home improvement stocks, the retailing stocks, the transportation stocks, the asset manager stocks, a lot of the areas that are linked to the economy, including real estate, are in official corrections. I had a client say the other day, "Where's this recession that you've been talking about? It's not evident in the stock market." Well, I got news for you. If you look at the most economically sensitive areas of the S&P 500, they're telling you the same story I'm telling you. The AI trade has nothing to do with the business cycle. That is long-term secular growth. And utilities and staples, really? You're going to say to me, this is a bullish stock market when they're at record highs and leading the way, the two areas that you want to own in a recession. Despite the fact that the stock market is still flat for the year and has done nothing since the November election. It's just been, I said at the beginning, a meat grinder and a roller coaster ride. That's all we've gotten. All we've gotten in the past 6 months in the S&P 500 that everybody, and I guess based on your question, that I would include you, Anthony, believes that the stock market is doing just fine. It's done nothing for 6 months. If you're bullish on the stock market, you don't want it to be flat. You don't want to be taking equity risk and capital risk and then have a flat market. That's not why you buy equities. You buy equities because you think they're going to be going up, but they have not been going up for 6 months now. To me, that's the more important story. The fact that we bounced off an oversold low in April, to me, is just background noise. The bigger picture is that the market is flatlining and that the most cyclically sensitive parts of the market are actually in decline. To me, that's the real story beneath the story.
Yeah, it's a great point, as you're saying, with the US dollar coming down as well, and then we're seeing outperformance in Europe. So they relatively, as you said, it hasn't been the trade to be in the last 6 months.
Yeah, look, the US dollar, talk about an important price. I mean, when you're down 8% in short order, peak to trough in the DXY, and what's usually a very stable unit. That's like the stock market going down more than 20%, risk on risk. So yeah, that is telling you something. The US dollar going down. And when you think about it, how does that make any economic sense? Normally, what's normal is that the country imposing the tariffs tends to see its currency go up, not down. The country that has the only central bank in the world that is not cutting interest rates, which is the Fed, normally sees its currency going up, and the US dollar is going down, and going down against virtually all G10 currencies. So when something is happening that is bizarre, that hardly ever happens, we have to wake up and pay attention as to what the foreign exchange market is telling us. And it's telling us that foreign investors have begun the process of reallocating out of U.S. assets. We don't know from the TIX data exactly where that's coming from. The treasury market has not been performing great, but it has stabilized of late. The equity market isn't doing great, but you could argue, well, it's stabilized of late. But something's happening because the price is always set by supply and demand and how those curves are shifting. And we know that the Fed is not printing a lot of money. The money supply numbers in the United States, M1 and M2, are running at about a 4% annual rate. They're basically running below or roughly in line with where nominal GDP is. So it's not that the Fed is printing money and we're seeing the dollar go down. There's something happening on the demand side as far as the US dollar is concerned. The question is, what sort of leading indicator will that be for other asset classes?
Yeah, it's a really interesting question. So what are you currently liking at the moment? Are there any assets that you're liking in this market?
That I like?
Yep.
Yeah. So let's go through them because I'm not telling anybody to go out there and load up on barbed wire and canned tuna and sawed-off shotguns. I think that you want to really you do want to de-risk the portfolio. Point number one, and this is just basic normal behavior in an environment of elevated and prolonged uncertainty. It's like how maybe one of the best things Jay Powell said, most instructive things, was last December after the FOMC meeting during the Q&A when he was asked about why the Fed's standing still. And he says, well, when you're in this period of uncertainty, it's like being in a dark room with furniture. You don't move. And you take a look at Warren Buffett and why he has a record cash hoard. He's not moving either. So maybe we shouldn't be moving. And when I talk about moving, I mean that we should be basically thinking about having a real bulletproof, as much of a recession-proof portfolio as possible. And that can be constructed because that's how my own portfolio looks. I think you want to have cash because cash is giving you a 4.4% yield. This is not 4 years ago when it was zero. And it gives you optionality. So you want to have some cash. I do think that 4.5% 10-year treasury yield, 5% long bond. I think that at a minimum, that is fair value. I like the yield. I like yields. I like yields where they are. So therefore, in the stock market, I like bond proxies. I like bonds and drag. I like utilities, fat yield, nice payout ratio, dividend growth. That's an area that I would be long of. Staples, they tend to at least preserve your capital when things get tough on the economy. So that would be otherwise food products, dare I say, tobacco, and of course, talk about fat yields. Not good for your health, but I think tobacco would be good for your wealth, so long as you don't mind owning tobacco stocks. Aerospace defense, not just in the United States, but globally. A global aerospace ETF, absolutely, because there you have visibility. Every single fiscal budget around the world is seeing expansion in their defense budgets, even in former pacifist countries like Germany, where of course they've broken the fiscal tourniquet there, and even in Japan. Military spending is going up. And I wouldn't limit it just to the United States. I would be involved in global aerospace defense. That's a very good place to be. I do think that I'm looking at AI as a game changer. It is not really that sensitive to the shifts in the business cycle. The valuations are stretched. I would agree with that. But if you have a real long-term view, AI is going to be changing the world, and it looks as though the spending is not going to really be slowing down. I mean, when you're taking a look, for example, at those GDP numbers in the first quarter, we had minus 0.2% annualized GDP growth. But when you're taking a look at the data center impact and the derivatives of that, you're taking a look at software and intellectual products and so on and so forth. That added alone about 1.5 percentage points to GDP growth. We would have had actually much greater positive GDP number. If we just exclude, if we just take a look at that sector alone, it was the leading indicator, and it's been doing that for the better part of the past couple of years. So I'm not unremittingly bearish. I would just be out of the most cyclical stocks, that's for sure. Consumer discretionary, I don't want to touch. Outside of aerospace defense, I don't want to touch industrials. I don't think I want to touch materials. The most growth, and you could talk about, I guess, cloud, AI. I guess that you want to put that longer term slice in your portfolio and just leave it there. And I don't mind that at all. And if you're looking towards geographic allocation, I could tell you that Europe is looking better and better. Europe is looking, I mean, Europe, the US market in its entirety is trading at a 21 multiple. And you got Europe trading at a below 15 multiple. The multiple is rising because long-term earnings visibility in Europe is also rising. So I would have a contingent of European stocks in the portfolio as well. So I would add on to that further gold, the gold mining stocks, silver's playing catch up, silver mining stocks. So you see, I just mentioned probably 10 things that you should have in your portfolio. Low beta, low cyclicality, a nice front-running yield, capital preservation characteristics. If you have the same portfolio today that you had 2 or 3 years ago, you're not doing yourself or your clients any service, because we are at a different point of the economic cycle. We are at a different point of the interest rate cycle. So I am being very selective. I've been pruning and culling the portfolio. I have it down to best ideas. And normally, in a raging bull market, you could just buy the SPX. You could have a real wide range of securities. But when the clouds come in, you want to cull the portfolio and get it down to your highest conviction themes and ideas. And that's what I'm doing. But just to reiterate, capital preservation is the key. And the preservation of cash flows is also the key. Low cyclicality, dividend growth, dividend payout. Of course, you want to have a contingent of areas that have the earnings visibility that will not be harmed by a recession. That's why I like aerospace defense. A recession is not going to hurt that sector. That is in secular growth mode right now. And gold, and I would add silver, but gold and the gold mining stocks make perfect sense in an environment where the US dollar has entered either a correction or bear market, and gold is 100% correlated with uncertainty. And it looks as though this trade and tariff war, and especially as it pertains to the bilateral relationship with China, is not going away anytime soon. So there you have it.
Yeah, thanks for laying it out for us. So, yeah, David, we've touched on so many points. So thanks so much for coming on the podcast. Really appreciate it. My last question is, what is one message you want people to take away from our conversation?
The one message?
Yep.
The one message is to play it safe. That it requires a lot of discipline and resolve to not chase these intermittent rallies. I would suggest use the rallies to cleanse your portfolio of undue risk and cyclical exposure. And to just think of what Walter Murphy, who is my technical strategist and was the legendary Bob Farrell's right-hand man for decades at Merrill Lynch. And what Walter told me very recently, because I was getting inundated with questions about how is the stock market surging? The stock market went up 18% from those April lows. Walter said that there's only two outcomes here. And this is really for your long only equity investors who are still balls to the wall bullish on the S&P 500. Walter said, and Walter is usually right, that this is either the last gasp of the old bull market or the first rally of the new bear market. So pick your poison. So I would not recommend buying the index. I would recommend thinking about thematic ideas, convictions, looking more towards Europe, and I would say even Asia, diversify out of the US, and take advantage of safe yield where you could get it. And you can get it now in the Treasury market where it's priced right now. And to focus on those bonds and drag, the dividend yield, dividend growth, payout ratio segments of the stock market, which is why utilities is ranking so highly in our work. And that's my main message.
Great, David. Thanks so much. It's a great message. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Right. Well, you could just Google Rosenberg Research and come on the website, or you could type in information at rosenbergresearch.com. And, one of my client service professionals will contact you. I will be happy to offer everybody on this call a 1-month free trial of everything that I do, because I like it when people get a chance to do a food tasting before they end up getting involved with the smorgasbord. So I always like to have people kick my tires, so long as they don't kick me. And if you want to reach me, I am at drosenberg@rosenbergresearch.com. Drosenberg@rosenbergresearch.com. So you see, Anthony, it goes to show how much I like you. I'm sharing my email. I will not share my phone number. That's getting a little too personal. But anybody on the call that wants to email me directly with any questions, happy to oblige.
Yeah, great. I'll put that in the description below. And yeah, maybe next time we get your phone number, if depending on what's happening. But
we just met.
I haven't wooed yet. Maybe not. Yeah, I need a few more interviews. But thanks so much for your time. Really appreciate it.
Okay, you too. All the best.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.